the stock market tends to attract in an awful lot of professional people. It's not difficult, but it's going to stretch most people. Lawyers and dentists, and they've got their house paid for maybe, and they're reasonably safe, and they've got £50,000 lying that they want to have a bit of a flutter with. What is the chances of you going to your dentist and leaving without paying? Pretty much zero, I would have thought. Okay, so an accountant, the books will invariably balance. Very few bridges fall down, so the civil engineers rarely have a disaster on their hands. The pilots, I know there's no levers anymore, but they pull this little lever and the thing goes up, and they push it and the thing goes down. So they live in a fairly an environment where whatever they do, a linear environment, and they now move from that fairly cozy little environment to something like the stock market, where when they're new, they're going to get this right 60% of the time, 40% of the time they're wrong, and they find it very, very difficult to deal with that. And getting your mind around this whole concept of thinking in probabilities, and at traders, we need two levels of belief. At the level of one trade, the market cannot be predicted. But at the level of 30 trades, you must firmly believe that whatever you're doing is going to make a heap of money. And that's quite unique to our business. That's quite unique to our business. I think that if anybody listening wants to read further upon that, then there's a book by the late Mark Douglas. It's called Trading in the Zone. And it's not an easy read, and it should be read half a dozen times. In fact, my trading partner recently has made a précis of the book, and I caught him reading it on an aeroplane the other day to try and get his mind around the whole concept of trading, thinking in probabilities. It's quite difficult, and it's been the most difficult thing that I've ever had to get my mind around, ever.
Hey traders, welcome back to the ComLucro channel. What a great way to start. David Paul showing why even sharp professionals struggle at first. The market isn't a linear, predictable world. It's a game of probabilities. Getting your mind around that is the first real step, and it sets up everything we'll cover today. Today, we open a new chapter of our course, Technical Analysis for Day Traders, Introduction to Technical Analysis. You'll learn what technical analysis is, how it differs from fundamentals, and why it's essential for fast, confident decisions. We'll also look at its origins with pioneers like Charles Dow and Munehisa Hama, and key ideas like market sentiment, price trends, and keeping your approach simple and objective. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. Let's begin. So what is technical analysis? It's the study of past market data, primarily price and volume, to forecast future price movements. Unlike fundamental analysis, which evaluates an asset's intrinsic value through financial statements, earnings, and economic factors, technical analysis rests on one idea. All relevant information is already reflected in the price. So it focuses on identifying patterns, trends, and signals in the charts, like learning to read the market's language. In essence, it's about understanding the psychology of the market, the collective behavior of traders. By reading charts, spotting patterns, and using indicators, traders anticipate where price is likely to go next. That's especially powerful for day traders who must decide quickly from immediate price action. Mastering this is fundamental to your success. Before the modern tools, let's see how it began. Technical analysis traces back to the late 19th and early 20th centuries, primarily through Charles Dow, a journalist and co-founder of the Wall Street Journal. Seeking a systematic way to understand market behavior, his work became what we now call the Dow Theory, the groundwork for many principles still used today. Dow observed that markets move in primary, secondary, and minor trends, and that these often reflect the health of the economy. Dow didn't invent technical analysis as such. He built the framework that grew into today's discipline. His goal was to help investors read market trends from patterns in the data. Revolutionary, because it shifted focus from an asset's intrinsic value to price movement itself, letting traders anticipate change. Another key development was candlestick charting, which originated in 18th century Japan. It was created by a rice trader named Munehisa Hama, often called the father of candlestick charting. Each candlestick shows the open, close, high, and low for a period, giving a clear visual of price, and crucially, patterns that can hint at future action. These charts later reached the West and became central to technical analysis. We'll touch on candlestick patterns here, but there's a full chapter on them later in the course. Knowing this history helps you appreciate why these tools still matter today. Let's bring in David Paul, who explains what technical analysis is really for, and why that understanding becomes your edge in the market.
We don't trade markets, we trade our beliefs about markets. So if those people have got that strong a belief in that, then it'll never work for them, that's for sure. There are some very, very advanced esoteric theories in technical analysis that are quite difficult to put into practice in terms of a structured trading plan. But I don't know many people in the city that make decisions without actually having a look at some form of technical analysis, some form of elegant level. So I think that comment is quite misguided. We really don't know that something is going to move up the page until it at least starts to move up the page. We can have all sorts of really, really flashy theories about value. There are many, I know a fellow who's lost his career as a fund manager based on a value trap. He bought this share because it was on a PE of 5, and he says this must be the greatest buy in history, and he bought a heap of them because they were cheap, and 6 months later they went bankrupt. So, and he lost his company based on that. By putting together good fundamentals and some simple trend following tools, you can in fact push your hit rate up enormously. So I'm not saying that you need to do advanced Gann analysis or start to count Elliott waves, but just some simple technical patterns in shares with good fundamentals, and you can put yourself into a position where you're getting it right 75% of the time. If you're right 75% of the time, you're only wrong 25% of the time. That minimizes the clusters, so you'll find the journey is emotionally not that difficult. If you're trading with fundamentals alone, for example, the value players, they've had a lousy 3 or 4 years, whereas the momentum players have done quite well. So if you're a value player, you've got to sit for a very, very long time until that value is noticed by other people. And if you've got, if you're managing somebody else's money and you have a bad year, you'll find very quickly that all of those people that said we understand risk don't quite understand as much about risk as they thought. Momentum works, but putting momentum with the fundamentals get you the best of both worlds.
That's the essence of edge. Technical analysis is how we build our own moat as traders. By reading the market, understanding trends, and recognizing repeating patterns, we stay ahead of the competition. Now, let's get into the core principles that form the foundation of technical analysis. They'll give you a solid base to build your strategies on. First, the market discounts everything. All available information, economic data, political events, even sentiment is already factored into the price. So instead of drowning in news and data, we can focus on price itself. The price action tells the full story. That's the beauty of technical analysis. It distills a flood of information into what really matters, the price. Second, price moves in trends. Trends are the market's heartbeat, and spotting them is key. Up, down, or sideways, they give us a roadmap. Once a trend is established, it tends to continue until something significant shifts the direction. Our job is to recognize trends early and ride them, aligning with the market's momentum instead of fighting it. Third, history repeats itself. Human behavior stays fairly consistent over time, so patterns from the past tend to reappear. We study them to anticipate future behavior, which is why chart patterns and indicators are so valuable. Recognizing a familiar setup lets us anticipate how the market may react, giving us an edge. To summarize, the market discounts everything, prices move in trends, and history tends to repeat. These three pillars guide our analysis and shape how we think about the market. Before we move on, let's hear from David Paul on why trading is genuinely difficult and why there are no shortcuts. This speaks directly to one of the biggest traps traders fall into, the desire to get rich fast. It's a mindset we must resist to succeed long term.
Your mother may told you that bad things happen in threes, okay? That's because life is mostly random, okay? And in 8 observations, you get a cluster of 3. In other words, a half times a half times a half. So in a 50% system, the hit rate, that's 1 out of 2 you should be right. 1 out of 2 you should be wrong, okay? What's the probability of 2 bad ones in a row? It's a half times a half, okay? 2 bad ones in a row. That means in a 50% system, every 4 trades, you have 2 bad ones in a row and 2 good ones in a row. Now, that means that if your hit rate comes down towards 50%, and many trend-following traders would sell their granny for a 50% system. Most trend-following systems are less than 50%. That in 4 trades, you're going to have 2 bad ones in a row. Now, most people will give up after 2 bad ones in a row, but it gets worse. What's the probability of 3 bad ones in a row? A half times a half times a half.
More.
Okay? Which means that you get a cluster of 3 bad ones in a row every 8 trades. You get a cluster of 4 bad ones in a row every 16 trades, and you get a cluster of 5 bad ones in a row every 32 trades. 5 bad ones in a row. How good will you be in executing your system with precision after 5 losses in a row? Okay, and that's the challenge in the short-term markets. As the hit rate comes down, then these ghastly clusters of bad luck start. And of course, a cluster of good luck, you can have a cluster of good luck as well. Cluster of good luck, of course, is actually more detrimental to your health than a cluster of bad luck, because in a cluster of good luck, you've got a little thing between your ears here called a pituitary gland, okay? And it pumps all sorts of muti. Muti is Zulu. It's a Zulu medicine. It pumps all sorts of muti into your bloodstream. So when you leave the gym after a good workout, you feel good, eh?
Yeah.
All right. And similarly, when you have 1 good trade in a row, 2 good trades in a row, the old pituitary gland gets to work and it pumps this stuff into your bloodstream. You feel good. You become euphoric. And when you become euphoric, the definition of euphoria is invincible. And you start to forget about all those position sizing, only risk 0.5%. You say, let's have a big bet. When you have a run of good luck, that euphoria takes over, and most people, in fact, go bankrupt after a run of good luck, not after a run of bad luck, because they think they're God and they forget about all those position sizing stuff. And it's happened to me on a few occasions
That hits home, because in trading, like in business and investing, it's tempting to chase shortcuts and quick wins. But lasting success is built slowly, with consistency, discipline, and simplicity. That brings us to a crucial but overlooked part of technical analysis: simplicity. When information is abundant and complexity overwhelms, simplicity becomes a necessity. Start with avoiding information overload. A common mistake is letting too much information wreck your trading style. Every influencer sells their own strategy as the best, which fuels constant second-guessing. After a loss or a missed trade, it's tempting to switch systems, chasing the perfect one, and that destroys both discipline and consistency. Here's the truth most influencers skip. Technical analysis isn't about precision, it's about probabilities. No strategy guarantees perfect outcomes. Markets are unpredictable. The edge comes from consistency, not perfection. So find a setup that fits your style. Define at least 3 clear entry rules and backtest each one rigorously. Backtesting shows how your strategy performs over time, without risking real capital, sharpening your approach and building discipline. As you go through this course, keep simplicity as your ally. Focus on what matters, cut the noise, and you'll navigate the markets with more confidence and clarity. With the principles covered, let's look at the essential tools to put them into practice. As a beginner, the right tools are crucial. Start with the basics, charts and indicators. There are countless indicators, RSI, MACD, and many more. But as a beginner, focus on a few foundational ones: candlestick charts, volume, and the 20, 50, and 200 period moving averages. Candlestick charts pack a lot of information into an intuitive format, showing both price direction and the strength behind the move. This analysis is rooted in historical data and covered in classics like Steve Nissen's Japanese candlestick charting techniques. Candlesticks form the basis of price action analysis, helping you read market sentiment and spot reversals. Volume is the next key indicator. It measures the shares or contracts traded and confirms the strength of a move. High volume moves are more likely to hold than low volume ones. That's why authors like Richard Wyckoff stressed volume in their study of market behavior. Reading volume alongside price gives you deeper insight into the market's dynamics. Moving averages are among the most widely used indicators because they smooth out price and reveal the underlying trend. Let's break down the 3 most important: the 20, 50, and 200 period, and the role of each. The 20 period is your go-to for short-term trends, smoothing daily fluctuations to clarify the immediate trend and potential entries and exits for quicker trades. The 50 period tracks intermediate trends and is a common reference for overall direction. A price cross above or below it can signal a shift in momentum. The 200 period is the long-term trend indicator, often acting as major support or resistance. How price interacts with it tells you a lot about the broader trend and whether the market is bullish or bearish. These aren't arbitrary, they're staples of classic technical analysis, detailed in books like Technical Analysis of the Financial Markets by John Murphy. The 20, 50, and 200 help you see the big picture while staying responsive to shorter-term shifts, keeping you above the noise and more disciplined. By focusing on these core tools, candlesticks, volume, and the 20, 50, and 200 period moving averages, you align with classic technical analysis and build a strong foundation. Next, where to find and how to use these tools. Among many platforms, one stands out for accessibility and popularity: TradingView. It's widely seen as the best platform for beginners, a user-friendly interface with powerful charting and indicators for all levels. A big advantage is access. It's free to start, with basic features that are more than enough for beginners, no upfront investment. You can also build custom charts, share ideas with the community, and backtest strategies on historical data, all in one place. But choosing the platform isn't enough. You have to truly know how to use it. It's like a driver's license. Knowing how to drive matters, but if you don't understand the car you drive every day, problems will come. Same in trading. Master your platform so you can execute efficiently, adjust quickly, and use every tool available. TradingView's ease of use, full features, and free tier make it the ideal starting point. Get familiar with it, and you'll be ready to analyze markets and develop your strategies. The key: start simple, master a few tools, then expand as you gain experience. With the foundation set, let's see how these principles apply specifically to day traders. Day trading is fast-paced and high-intensity, demanding quick decisions and precise execution. In day trading, speed is everything. Quick, informed decisions can be the difference between profit and a missed move, exactly where technical analysis becomes indispensable. By focusing on price action patterns and key indicators, day traders react fast. Markets shift in an instant, and a solid grasp of technical analysis lets you decide with confidence. Whether spotting a breakout or a reversal, the faster you read and execute, the better your odds. Unlike swing traders or investors using daily, weekly, or monthly charts, day traders work on much shorter time frames, most commonly the 1-minute, 5-minute, and 15-minute charts. These give a detailed view of immediate movement, so you can capitalize on small fluctuations through the day. Short time frames need their own strategies. Approaches like scalping, profiting from small price changes, or momentum trading, riding strong moves, are popular among day traders, and both lean heavily on reading indicators and conditions quickly. Remember, day trading isn't about predicting long-term trends. It's about reacting to what's happening right now. That precision and speed make technical analysis not just a tool, but a necessity. One costly mistake is turning a short-term trade into a long-term position. If you analyze the trend on a 60-minute chart and enter on a 5-minute chart, never change that because you can't accept a stop loss. Shifting to a 4-hour chart and 15-minute entries just to dodge a loss is a recipe for disaster. And this applies to any time frame you trade. Another critical, unforgivable mistake is averaging down on a losing trade, cost averaging. There are setups built for it, and if you'll use them, study and test them thoroughly, but never turn a strategy that isn't based on cost averaging into one that is. The trap, most of the time you do recover the trade, so you don't notice you're drastically raising risk and cutting your reward ratio. One gap or news release can devastate you. And if the trend continues without reversing, the loss can become irreversible. I'll say it again, so it sticks. Never turn a non-cost averaging strategy into a cost averaging one. It could be the worst mistake of your financial life. To close, let's hear from Dr. Brett Steenbarger, a leading voice in trading psychology. His work has helped thousands of traders spot and fix the emotional patterns that quietly sabotage performance. Here he breaks down two common traps: under control and over control.
What are the situations that typically set you off? In trading, most of the problem behaviors are problems as the result of under control or over control. Under controlled behavior would be trading impulsively. I suddenly forget about my position limits and I'm trading much larger size than I should be. I'm suddenly not honoring my stops. I know I shouldn't be adding to a losing position, but I keep finding myself doing that. That's an under-controlled behavior. The opposite would be an over-controlled behavior. I'm so anxious I can't pull the trigger and make the trade. My system told me that I was supposed to go long in the morning, and I just sat there and watched the whole damn thing go up and up and up and up. That's an over-controlled behavior.
That's why emotional discipline is just as vital as a solid strategy. Knowing when to act and when to hold back is what sets consistent traders apart. Today, we covered the core principles of technical analysis, timeless ideas that help you avoid common pitfalls and trade with clarity. At its core, technical analysis isn't just charts or indicators, it's a mindset. The market reflects everything, trends matter, and history often repeats. Pair that with simplicity, the right tools, and discipline, and you've got the foundation for lasting success. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts, it's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.